Okay, folks, good morning and welcome to Swing Trading Today. This is Bob Desmond, and what we're going to talk about today is inflation, the CPI report, which came out yesterday, and the price action of gold and the gold miners, of which we're long, and why they didn't rally. I mean, they closed up, but they sold off the highs of the day. And so we're going to talk about what's it going to take for gold and silver and the miners to really get moving. So stick with us. We're also going to talk about a trade that we did on Goldman Sachs, and that was an options trade, and we closed that out for a little over a 50% profit yesterday. Let's go to the trade. So this is not a very difficult trade to try to figure out. It may take some time for some, but here's the trade. We sold, this was in advance of earnings. We sold the 400 strike call contracts expiring this week, this Friday. We also sold simultaneously, to balance out that position, the 362.50 puts. And the way we decide on these trades is the risk worth the reward? So in this case, we had a max profit potential of $2,222. So 10 contracts times $2.22 per credit versus our risk. What was the probability of the shares trading above 400 and the probability of the shares trading down below 362.50? Well, we had nearly a 94% probability of profit. You may be saying, how is that possible? How could you generate that type of cash flow with so little risk? The reason is called implied volatility. Implied volatility expands. If you wonder what influences the price of an option, it's demand for that option, supply and demand. Excuse me. So the options were in demand in advance of earnings, and then the demand drops off after earnings because it's a sell the news event. Nobody wants the options anymore, unless, of course, they see a really great directional play and the options are still cheap and it's a great way to get to where they want to be. That was not the case with Goldman Sachs. So we booked our profits. This is our closing trade. We booked our profits. We did this in advance. You don't need to sit in front of your computer. Know what you want to make, roughly 50% in this case. And we exited the trade. Remember, we were paid $2.22. And we closed it out for $1.09 per contract. So again, a little over a 50% profit. So good trade. There are going to be plenty more of these to come this earnings season, and members expect more. All right, let's get to the pre-markets, then we'll talk about gold. Okay, this morning we're going to begin with the dollar because the dollar is a critical factor along with bond prices to determine at what point in time do we want to go adding to our long positions on gold, silver, the miners. And you can see here, this is a 4-hour chart, that yesterday the CPI data came out. It was very hot on both the headline and the core number. The core number is what the Federal Reserve conveniently uses because it backs out food and energy. And very hot number. So the knee-jerk reaction of traders was to buy dollars. I guess they taught it in Harvard Business School. I don't know. I don't know why they do it. It doesn't make sense longer term. I guess short term, yeah, but when you're dealing with with an economy that is built on cheap printed money, and you know the moment that they stop printing that cheap printed money out of the Federal Reserve and Treasury, it's all over. This economy is built on cheap, baseless money. So the assumption that the traders use is that, okay, CPI data came out hot. What we're going to do is we're going to buy dollars because the Federal Reserve is going to have to move. They're going to have to raise interest rates a lot quicker than what was expected. No. They can't even taper. They can't even roll debt off their balance sheet because that's a quasi interest rate hike. Yields move up higher and the stock market buckles. And they're not, unless they're forced to by market pros or AKA bond vigilantes, they are not going to allow yields to press up higher beyond the 2% threshold because this whole game of cards is going to come undone. And especially in advance of the midterm elections, which are just around the block. So they have stated they're going to let inflation run hot, and a lot of people get confused by the Federal Reserve, and I try to keep it simple. Don't listen to what they say, watch what they do. Don't listen to what they say, watch what they do. They like to play good cop, bad cop. Powell, good cop sometimes. Bullard, bad cop sometimes. And they try to mess with your head. They want to take parking space up in your head, keep you guessing about, They're going to have to move quickly. But the reality is they can't. And they want inflation because they want to inflate away the debt. Doesn't matter if you have to pay $1 more per gallon at the fuel pump. Doesn't matter. So that's the only way they get out of this fiscal nightmare that they put this country into. So the dollar surged yesterday. Will this continue? I'll tell you, you take a look at a daily chart of the U.S. dollar. Pretty good day yesterday. Really, really good day yesterday. We had pulled back off the highs. We have a W formation forming here. It looks as though we're going to head higher, but I'm telling you right now, I'm not going to be the least bit surprised at any given time to see this dollar just roll over. Once traders wake up and they finally get it, they finally realize Fed can't do a god-darn thing except let inflation run hot, or else this whole thing comes apart, meaning the stock market. So in the short term anyway, I would expect higher highs. Given the technical view of the U.S. dollar, might we see a short-term correlation between gold and the U.S. dollar? Yeah, at some point in time, you're going to see some stealth accumulation of gold. You may not get it right away with the gold mining stocks. They may lag a little bit, especially if the markets begin to sell off in anticipation of a Fed rate hike, because we have a tremendous amount of leverage in the market, meaning margin debt. And if you have forced liquidation, your broker's not going to care about what he sells. He's going to sell whatever he could sell, whether it be a gold stock, a tech stock, doesn't matter. They're going to have forced liquidation. So gold stocks and silver stocks, which we own, are stocks in and of themselves subject to liquidation and more volatility than gold. But if you're looking for wealth creation during this inflationary time, watch these pullbacks on the gold stocks. I mean, take a look at GDXJ yesterday, of which we are long. And you see the sell-off, the highs of the day yesterday. Disappointing. I was hoping we were going to close at the highs of the day. But frankly, the rise in the U.S. dollar and the rise in this chart here, the 10-year yield, made it very questionable that we were going to hold the gains of the day yesterday. We did not. That may change today. This is one of the rare times. I shared this with members last night on Market Wrap. This is one of the rare times where I look at this chart and I say, you know what? We could see a situation here where the technicals just get trumped by the inevitable, which is a decline in the U.S. dollar and you're going to see accumulation of the gold stocks, and we'll be watching very, very closely to add to that position. Would I be surprised to see a shakeout here, a crushing of the weak longs, because you have a lot of resistance at $60 a share on the NUGT, which is a leveraged ETF, which we own as well, for the gold stocks? I wouldn't be the least bit surprised to see that. Right now, we're sitting on our hands, watching, waiting, and we know that as long as yields move up higher, along with the U.S. dollar, it's going to be difficult for the gold stocks to continue a strong momentum higher. Now, that's going to change. And when will that change? Again, when people wake up and they say, okay, this dollar is a joke. 25, if not more, 25% of all U.S. dollars in existence were printed within the past 18 months. Think about it. And when you see bonds drop, as you saw with the TLT yesterday, this is a 20-year bond ETF, along with the U.S. dollar, then you know you need to be in gold, silver, the gold stocks, because that will be a crisis of confidence. That is when you're going to see a strong momentum higher here in the gold stocks, in silver, precious metals, whatever you can drop on your foot and it hurts, you want to own it, because when you see bonds drop along with the U.S. dollar, crisis of confidence, you better own something that is tangible. Let's go back to the pre-market futures. All right, so the pre-market, we're seeing the dollar weaken up here. This is a 4-hour chart. This bar opened up at 5 a.m. Eastern Standard Time. It'll close at 9 a.m., obviously, because I'm using a 4-hour chart. Very big genius here. So a lot can happen here. We could reverse the close higher. We don't know yet. Now, when you take a look at the dollar pulling back, you probably see gold up. Let's check out gold. Gold is up. Now, gold has been stuck in this trading range here with the lower band in red, upper band in green since the 25th. It's the 5th of July. First cup of coffee, folks. Sorry. And we are flirting with a breakout here. We're going to be watching this quite closely. This is a nice, strong consolidation. Taking a look at equities now. Equities, we are seeing a tick higher on the small caps. The small caps took it on the chin yesterday. Normally they would rise with rising yields, but remember the whys behind why an index or stock or anything would rise with interest rates. The read into that type of move on interest rates is that, wow, the economy is growing. Therefore, the next sector rotation should be into growth stocks, should be into mid caps, small caps, micro caps. But people realized that this is just a pure inflationary reaction by the bond market, driving interest rates up higher because people are dumping bonds in anticipation of a Federal Reserve raising rates. Now, I think that the bond market in and of itself can keep those longer dated maturities, 10-year, 30-year bonds moving up higher, 20-year, all by themselves. So yields moving higher all by themselves. And if we don't have economic growth, you're going to see the small caps under a lot of pressure. And remember what's been driving this economy, folks. It's not new jobs, as they like to say. It's people returning to work. It's the Federal Reserve and Treasury working in tandem to print more debt. Here are the S&P 500 E-minis up slightly on this session. The NASDAQ 100 up on the session by a little over a third of a percentage point. If there's one space that I'm becoming more and more bearish on, and I've spoken about this in the past, took a lot of heat for it, but it's okay, are the tech stocks. This pullback in yields has allowed the NASDAQ to rally over these past several weeks. I think that is now over. And we could still see a bid under tech stocks through earnings because they don't want to let the tech stocks go down. And as long as they keep yields down below 1.5%, you could still see tech rally. Once we go above 1.5%, it's going to be very, very difficult to keep a sustained rally. And I think that the NASDAQ 100 is going to come under a lot of pressure. So we're going to be looking to add to our short trade. Moving on to the bond price, the 10-year bond price. If it's up, that means that yields are probably pulling back. We're up slightly. So we're seeing a little bit of pressure coming off of yields, allowing tech to rally, allowing the other sectors of the stock market to rally as well, small caps, large caps. Will it last? That's the big question. The VIX, I cleaned this up last night. I had a lot of lines on here, but the line in the sand you want to watch is what we're retesting right now, 1753 on the July contract, the front month contract. And what we'll be looking for is, I'm going to create a tripwire here. This is not necessarily a short signal of the S&P 500. It just keeps you on your toes, letting you know where the directional move is trending. I want to know if we begin to break out off of these lows, which I think we're going to do. And once we break out above this line in yellow, do a retest, we're going to probe this upper band in green. And once we begin to break out above this upper band in green, this has been a consolidation range ever since May. We break out above this upper band in green, you're going to see a lot of heat come down on the S&P 500. The dollar, I cleaned up this chart last night. I wanted to go back to it for a moment. I wanted to create a line in the sand at which we really need to identify when the dollar is breaking down in earnest. And I like to use a 4-hour chart because it's not a daily chart. It's half of a daily chart, but it's not a highly volatile chart. So it's not like we're day trading. It's just our early warning signal. And I want to know a couple of things. One, do we break out? You can see I already have an alert set up here to mark a breakout. And that'll keep us away from assets that trade inversely of the US dollar. But if we break this support level here on the US dollar, that would mean an end of this rally off the lows, which began late May. And that would have us leaning into our long trade of gold and commodities and whatnot to take advantage of the decline, assuming that bonds are still dropping, which I believe they will, and the decline of the US dollar, because that's going to be your catalyst for the rise in commodity prices. So we're going to create an alert here. And there's no need to sit in front of your computer all day. Set your alerts. These come to your iPhone or your Android, whatever, and they alert you. And we're good to go. All right, what else do we want to go over here? I think Citi reports this morning, right? Maybe even, is Wells Fargo today? All right, nothing out of Citi. We have Bank of America, Citigroup. Those are the names reporting today. Let's bring up Bank of America. Unlike Goldman, we didn't trade options trades on Bank of America or Citi because the volatility simply wasn't there. The risk reward wasn't there. Same thing with Delta Airlines. I wanted to, but not enough volatility, so we walked away from it. If you don't have a really, really great probability of making money with a option strategy called the Strangle, which I displayed earlier at the open, walk away. Too much risk, not enough reward. All right, let's go to some chart requests, and we'll wrap this up, get the day started. All right, we have a couple to go over for members. Bear with me, there we go. Okay, folks, we're going to be using TrendSpider, automated trend lines, technical analysis, algorithms, whatnot. Institutional technology for the retail investor now. There is a 35% discount code below, lowest price on the web. Take advantage of it. We need to go over some requests, so let's do it. We'll go over a couple of ones that we put alerts up on that have yet to fire off. LNG, very interesting one. Wow, it broke down. And this is why we set an alert down here, because we were flirting with resistance and you can't buy it up there. So unless you break out, we didn't break out. We have rolled over on a weekly time frame now, and I would look for a retracement back down initially to these moving averages, which are still rising. But just a quick warning here. You have your RSI with lower highs. Do we have lower lows? It appears that way. Yeah, we do. All right, so the week is not over. A few more trading days left to go. We'll circle back on this one, maybe on Thursday night. The daily chart, I mean, wow. Rough day yesterday. I just took the automated trend lines off. We had lower highs. We did now break down to new lower lows. And next support level using the algorithms, aka automated trend lines. Click of a button. Bam. Right here at 83.05. We'll create an alert there. Touch, bounce, breakthrough. So I wouldn't necessarily go buying here at the support level, unless, of course, we sold off hard, then reversed to close back above it. That would be a bullish reversal bar on the day. That would be very interesting. RL, good morning. Mid-Mark, good morning. Higher inflation means even more money printing. I'm sure they won't stop. Agreed. And at some point in time, people are going to wake up. You know, we've had this inflation issue going on for, a couple of quarters now. What's the Federal Reserve done? I'll go back to what I said earlier. Don't listen to what they say, watch what they do. And they've done absolutely nothing but make the problem worse. And they're trying to jawbone the market saying that it's transitory. The only thing that I could say that appears to be, possibly transitory are used car prices, which have certainly added to the CPI. And the reason why you have used car prices moving up so high, prices of new cars, parts unavailable, etc., from the producers. So maybe that's transitory. I don't know. That certainly moves in a cycle. But food prices have been very, very stubborn. Commodity prices have been very stubborn. We've been talking about commodity prices here at the Contrarian Trader for well over a year that they've been on a tear. So what they're talking about being transitory over at the Federal Reserve, you got to define what transitory is. Transitory means temporary. So what's temporary? A couple of weeks, a couple of months, a couple of years. They need to get a little bit more granular. Let's go to SPCE, Virgin. Okay, so a rough week after Sir Richard Branson went into space. I think we're coming down here to 3503. Does it hold? It really depends upon the market. I mean, this is a highly speculative stock. RL, you typed in Wells. I'm not sure what that means, pal. Can you elaborate a little bit? All right, so SPCE. We'll keep this active for a couple of weeks. I think this is an opportunity. I mean, I think that this sector, this space sector, is for real. As costs come down, I think that the Virgins of the world. I don't know if Bezos's plan is to have retail go up in his space flights, whatever they are, but Blue Origin, I believe it is. But Virgin right now seems to be the only pure play for this type of trade. So I like it, just not right now. I think there's a little bit more damage to get done here. If this market weakens up, you could bet that these highly, highly speculative names, you can see I had an alert here, and it warned me that we were retesting support and it failed. So let's get rid of this. These highly speculative names on any sell-off, they're going to get clubbed over the head. INTC. Good morning, Ed McDeal. Hey, listen, do you know when they report? 2 weeks from now, I think it is? We'll leave off at this one. All right, so I want to point out, again, the value of the automated trend lines here. You could argue, and rightly so, you could argue that Intel's looking pretty good on a weekly time frame. 722? Okay, thank you. We have a higher low here. So what have we done? Step one, to buy a stock that's been in a free fall is the obvious. It's got to stop going down. Check that box. We already did it. Step two, we need to put in higher lows. Do we have that? Pretty goddamn close. Looks that way. So looking good from that perspective. Step number three, we need to break out above primary resistance level number 1. We're not there yet. Step number 2, or step number 3, is that we break out above the pivot point. Here's EW formation. The pivot point is at 58.40. You want to see a breakout above, first, this resistance level here. That gives you the pretty much excuse me, the all clear that we're probably going to head up to 58.40. No guarantees we're going to break out above it, but if and when we do, it's game on to the long side, because then you have a change from a downtrend to an uptrend. So the weekly chart is looking promising. You could see they tried to break it out yesterday, but it was rejected. So we're very close to a breakout at around, let's call it 57.50. Volume could have been a bit better. So we're close to a buy signal here. I would stay small and then look to get aggressively longer on, again, a rally up through that pivot point at 58.40. And with that, folks, thanks for joining. If you could smash that like button, I'd appreciate it. Again, TrendSpider, 35% discount code below. Everybody have a profitable trading day. Thanks for joining in. Be well.